Okay, let's do this. We are diving headfirst into a whole stack of listener questions all about, well, investing.
Yeah, it's a big topic, isn't it? It can feel pretty dense, maybe a bit intimidating sometimes.
Definitely. But our source for this deep dive, it's perfect for cutting through some of that noise,
Absolutely. We're pulling insights from a great transcript, actually. It's from the Making Money podcast, and
yeah,
they were just taking questions directly from their listeners.
which is brilliant because they're probably the same questions you, our listener, are thinking about right now.
Exactly. So think of this as us trying to unpack the best answers, the key takeaways from that chat.
That's the plan. Our mission here is to pull out the most valuable, kind of actionable nuggets from that conversation
To help you feel, a bit more confident, understand things better.
and maybe have fewer headaches when it comes to putting your money to work.
Yeah.
So yeah, let's jump in.
Okay, so one of the first things, and it comes up constantly in questions, is this fear of market volatility. Those stomach churning ups and downs, especially the big drops, the crashes.
Totally. It feels like this huge risk you just have to avoid, doesn't it? People hear correction or crash, and the instinct is often, well, panic, run for the hills.
Right. But here's where the source material offers a really powerful, maybe different perspective. Market drops. They aren't these weird, rare events. They're actually normal, expected even, part of the whole market cycle.
Yeah, essential even.
Exactly. And the data they talked about is, well, it's quite eye-opening. If you look long-term, say the S&P 500, something like a third of all years actually see
A
declines.
third. That's a lot more than people probably think.
It is. And here's the real kicker, the thing that challenges that idea of smooth, steady growth we all hope for. A minus 20% drop in any given year. Statistically, that's actually more likely than hitting the average, the often quoted plus 10% annual return.
Wow. Okay, thinking about it like that.
It
It does help reframe the fear a bit, doesn't it?
Yeah. It really does. And the main idea they kept hammering home was the power of just zooming out.
But looking at the big picture.
Precisely. When the market drops 5%, 10%, whatever, the daily headlines feel awful, like the world's ending sometimes.
Uh-huh.
But pull up those long-term charts, the ones going back decades. Today's drop, however painful right now, it often just looks like a little blip. It doesn't wipe out all the strong growth that came before it.
And this leads into that classic analogy they use, the sale analogy.
Ah, yes, the sale. It really nails the point, doesn't it? If you've got decades, literally decades, before you need to touch that money.
Which is true for many people investing for retirement, for example.
Right, then these market dips are basically just a sale. Assets are cheaper. So thinking about running away from the market when it's down.
It's like running out of the department store when the January sales are on.
Exactly. If you're buying for the long term, the smart move often is to be running in, not out. Or at least just sticking to your plan.
Love that reframing. Now, they did make a distinction, didn't they? This buy the dip or stay the course mentality works best if you have a long time horizon. What if you're closer to needing the money, say 5 or 10 years from retirement?
Good point. Yeah, the perspective definitely shifts then. If retirement is getting closer, planning becomes absolutely critical.
And they stressed doing this planning before you actually retire?
Yes, years in advance, ideally, not on retirement day itself. This means actively building things like cash buffers, maybe having 1, 2, even 3 years of essential living expenses set aside in cash,
Okay.
or using strategies like bond ladders, basically bonds maturing at different times to give you predictable income, or even looking into annuities for a guaranteed income stream. The point is getting these things ready before you stop working.
And the big reason for having that buffer, that safety net, is to protect against something called sequencing risk.
Precisely. Sequencing risk. That's the jargon, but it's a really important concept. It's the danger of being forced to sell your investments when they're down right at the beginning of your retirement, just as you start needing to draw an income.
Which can seriously damage your long-term prospects.
Hugely, because you're selling low and locking in losses right when you need the money most. Having that cash buffer means if the market tanks the year you retire, you can live off the cash for a year or two, give your investments time to hopefully recover, rather than selling them at the worst possible time.
And building that buffer, say 1 to 3 years of expenses, that takes time. You can't magic it up overnight.
Exactly. It underlines why that planning needs to start maybe 5, even 10 years out from retirement. It takes discipline to build it up.
The source also touched on external factors. How leaders, political events, wars, how these things can really rock the markets in the short term.
Yeah, they gave an example, didn't they? Talking about how the actions of maybe one particular leader could cause a lot of uncertainty and choppiness.
Right, like implementing tariffs or trade policy.
Exactly. Things like tariffs makes goods more expensive, which isn't great for businesses, at least in the short term. And the market reacts to that immediate uncertainty, that potential hit to profits.
Even if nobody really knows what the actual long-term impact will be.
That's the thing. The market often reacts first and asks questions later. The crucial takeaway here, though, especially for long-term investors, is, well, try not to react impulsively yourself.
Stick to your own plan.
Stick to your plan based on your timeline, your goals, not based on the day-to-day headlines driven by politicians or events you absolutely cannot control. Easier said than done sometimes, but vital.
Okay, really clear. Let's switch gears a bit. There was a fascinating listener question about passive funds, like index trackers. The question was, does their growing popularity actually make markets less volatile?
Yeah, that was interesting. Because intuitively, you'd think maybe it would, right? Less active stock picking, more just buying the whole market. Maybe things smooth out.
That's what I would have thought, but the source suggested kind of the opposite.
Exactly. Counterintuitively, they pointed to research suggesting markets might have actually become more prone to sharp, sudden drops, more crashy was the word used, since around the year 2000.
More crashy.
Yeah. Apparently, something like half of the major market crashes studied happened post-millennium.
Wow. Okay, so if it's not the passive funds themselves calming things down, what is driving this increased volatility, according to the source?
Their argument focused on the sheer ease of buying and selling for everyday retail investors today, and that includes people holding passive funds.
The ease of trading. How so?
Well, think back 20, 30 years ago. How did you get market news? You waited for the morning paper, maybe watched the evening news bulletin.
Right.
And if you wanted to trade, you had to physically pick up the phone, call a stockbroker, explain what you wanted to buy or sell.
And the broker might even chat with you, maybe try and talk you out of a rash decision.
Exactly. Those steps acted as natural, built-in cooling off periods. There was friction in the system. And
Now, you've got news feeds flashing updates on your phone 24/7, often with, let's be honest, pretty sensationalist doomsday headlines designed to grab clicks. And crucially, you can log into your brokerage app right there on your phone and sell your entire investment portfolio, index funds, shares, whatever, in literally seconds. A few taps, and it's done.
So it's that combination.
Yeah.
Instant, often scary information, plus the immediate ability to react.
That's the core of their argument. This unprecedented speed of information and the near frictionless ability to act on it fuels impulsivity. It allows fear or greed to translate into market moves much, much faster, leading to these wilder, quicker swings.
So it's less about what people are holding, passive versus active, and more about how quickly and easily large numbers of retail investors can react and trade anything.
That seems to be the perspective presented in the source, yes. That ease of access and speed of reaction for the masses is a bigger driver of this kind of volatility than the specific investment strategy itself. Okay, let's pivot to something super relatable. A listener dilemma that causes, I think, a lot of real stress for people.
Yeah.
How do you balance investing for your future, long-term goals with needing money for life now?
The big juggle. Paying the rent, saving for a house deposit, wanting to go on holiday, maybe saving for a wedding. How do you fit investing in amongst all that?
Yeah, it feels like you're being pulled in a million directions.
Totally. We all want to do everything, right? Have the nice holiday and max out the pension. But the core insight from the source here is pretty blunt. You probably can't do everything all at once, equally well. You have to prioritize.
And their big recommendation for how to prioritize investing.
It's the classic pay yourself first principle.
Okay, explain that.
Basically, you make your investment contributions non-negotiable. Decide how much you're putting away for your long-term goals or retirement, maybe a house deposit in a specific account like a Lisa, and set that money aside first.
Like as soon as you get paid, before you even think about other spending.
Ideally, yes. Automate it if you can. Treat it like any other essential bill, like your rent or mortgage. It has to be paid. Only after that money is safely tucked away for your future self, do you then budget and spend what's left on everything else. Bills, fun, holidays, the lot.
But why make investing the top priority? Why not save for that holiday first? Enjoy life now.
Because investing is fundamentally about securing your long-term well-being. It's The thing that allows you to keep affording things down the line, so you can still go on holidays when you're retired, so you have security, so you have options.
Ah, okay. So paying yourself first for investing ensures your future self is looked after.
Exactly. It's about ensuring future you can still live the life you want.
And it's okay if maybe you haven't done this perfectly in the past. Maybe you're only just realizing its importance.
Absolutely. The source was clear. It's fine to start small, or if you've maybe ignored it before. But once you grasp why it matters for retirement security, maybe using tax breaks in ISAs or pensions,
Yeah.
then you build that priority into your system.
Make some rules and try to stick to them.
Yeah, have a system. And they did offer a guideline on how much might be reasonable for retirement specifically. Around 15% of your income was mentioned as a common target, and importantly, that includes any match you get from your employer in a workplace pension.
Okay, so aim for 15% total going into retirement savings.
Including the free money from your boss, yes. Get that sorted, pay yourself first, and then the source suggests enjoy the rest. Budget it, spend it, live your life.
That 15% is a useful benchmark.
Right.
All right, okay, another specific listener question, this one from Ian. He asked how he could invest himself. Maybe avoid the potentially higher fees charged by some robo-advisors, which he noted the source had been a bit critical of.
Right. Yeah, the perspective in the source was definitely that some robo-advisors, while convenient, can charge fairly chunky fees, maybe 0.7%, even 1% or more per year.
On top of the fund fees themselves.
Often, yes. And the argument was they're charging this fee to essentially do something quite simple for you. Put your money into a basket of low-cost index funds.
Making it seem more complicated than it is, perhaps.
That was the implication, that maybe the platforms sometimes make it seem like this complex proprietary process to justify their fee, when underneath it's often just standard building blocks.
So the how-to for doing it yourself, DIY investing, is actually pretty straightforward.
It really can be. The advice given was basically, find out what funds the robo-advisor is actually using. They might have fancy names for their portfolios, cautious, adventurous, whatever. But if you dig into the fact sheet or the key information document,
You can see the underlying holdings.
exactly, you'll often find they're just using standard global index funds or bond funds from the big, well-known providers like Vanguard, iShares, BlackRock, HSBC, etc.
And once you know what those underlying funds are, then what?
Then you can potentially just go directly to a brokerage platform, open an SIP or a SIPP, self-invested personal pension yourself, and buy those exact same underlying funds directly.
Cutting out the middleman.
Essentially, yes. The source mentioned platforms they use personally, like Vanguard's own platform, which is great if you mainly want Vanguard funds. Or others like Trading 212, Invest Engine were mentioned as low-cost options.
What about Hargreaves Lansdowne? I think that came up too.
It did, yeah. Noted as being generally more expensive, but perhaps offering a wider range of funds or features that some people might value, maybe specifically for things like a junior ISA. But the core idea is you weigh the cost versus the benefit. Often, going direct cuts out that extra layer of platform fee.
It's like the analogy they use buying wholesale directly from the provider versus paying the markup at the corner shop.
That's it, exactly. Cut out the extra fee layer. And this connects really nicely to another listener question, actually, about whether it's okay to have just one fund.
Ah, yes. Does owning only one fund feel? Well, wrong. Too simple. Risky.
It can feel like that, can it? Like you should have lots of different things. But the source really highlighted the incredible power and, importantly, the simplicity of using a single, well-chosen global index fund.
Like the FTSE Global All-Cap Fund that keeps cropping up.
Precisely that kind of fund. A global index fund isn't just buying one company. It's designed to hold literally thousands of companies. All the major businesses across the entire developed world, and often emerging markets too, all weighted according to their size in the global market.
So it feels simple to buy, just one click, one transaction.
Right. Feels simple up front. But underneath the bonnet, it's incredibly complex and diversified. They use that funny analogy like a microwave pill dinner. Just add water and boom, you get this incredibly complex meal with thousands of ingredients, perfectly balanced.
I like that. So buying one global index fund instantly gives you huge diversification across different companies, different industries, different countries.
Yes, it's often called the only free lunch in investing for that reason. You get incredibly broad diversification, reducing company risk, sector risk, country risk very efficiently and usually at a very low cost.
But in this seemed crucial. It has to be a truly global fund, right?
Absolutely critical point they stressed. Just buying a single country index fund like only buying a FTSE 100 tracker in the UK or only an S&P 500 tracker in the US that is not globally diversified. You're putting all your eggs in one country's basket, which is a very different, much riskier proposition.
Got it. Global is key for that single fund approach. Now, speaking of diversification, let's look at a specific listener example. Billy shared his portfolio. He's investing in a Vanguard S&P 500 fund, an Invesco NASDAQ 100 fund, and also the Vanguard FTSE Global All Cap Fund. He asked if that setup is diversified enough.
This is such a great and really common example. It highlights the potential pitfall we just talked about. Billy's clearly trying to diversify by buying multiple funds, which is the right instinct. But by combining these specific funds, he's likely ended up accidentally over-concentrating his investments in one particular area.
Really? How does that happen? They sound different. U.S., tech, global.
Let's break it down. The S&P 500 tracks the 500 biggest U.S. companies. It's already heavily weighted towards big U.S. tech firms like Apple, Microsoft, Amazon, etc., just because they're so huge.
Okay.
The NASDAQ 100 is even more focused. It tracks the 100 largest non-financial companies on the NASDAQ exchange, meaning it's absolutely dominated by those same U.S. tech giants. It's basically a U.S. tech fund plus a few others.
Right. And the global all cap.
Well, the global all cap is global, but it allocates based on market size. And right now, the U.S. stock market makes up something like 65% of the entire world's stock market value. So that global fund is already heavily invested in the U.S., including U.S. tech.
Okay. I see the overlap now. Big time.
Huge overlap. So when Billy holds all three funds, his overall portfolio is probably somewhere around 80%, maybe even 90% exposed to the U.S. market. And within that, he's got a significant double or even triple dose of the big U.S. tech companies.
So he thinks he's spreading his bets, but he's actually loaded up heavily on one area.
Exactly. They used a roulette analogy, didn't they? It's like putting chips on the number 3 and putting chips on the first third of numbers, which includes 3, and putting chips on the whole board, which also includes 3. You end up with a massive pile of chips specifically on number 3.
So adding extra U.S. funds or U.S. tech funds on top of a global fund doesn't add diversification from a global perspective. It actually reduces it and concentrates risk.
Precisely. It makes the portfolio much more vulnerable if the U.S. market hits a rough patch or if the tech sector specifically underperforms. Even though that combination might have done brilliantly recently because U.S. tech has flown, the point is understanding whether that concentration is a conscious decision or just an accident from overlapping funds. It's about knowing what you own and why.
Makes sense. Let's touch briefly on a specific asset, gold.
Yeah.
A listener asked about investing in gold. What was the take?
Well, the speakers in the source mentioned they don't personally hold much gold for investment reasons, but they did clarify the simplest way to get exposure if you do want it.
Which is
Buying gold funds. Usually exchange-traded funds, ETFs, or sometimes called exchange-traded commodities, ETCs. You can buy these easily on most standard brokerage platforms, just like buying a share or any other fund.
so much easier than buying actual gold bars or coins.
Oh, infinitely easier. Buying physical gold comes with all sorts of headaches. You've got to think about secure storage, which costs money, insurance, transport. And they even mentioned something I hadn't thought of, needing specific humidity control.
Humidity control for gold.
Apparently.
Yeah.
To stop it tarnishing over the very long term. Who knew? It just highlights the complexities you avoid by simply buying a gold ETC or ETF on your platform. Much simpler.
That humidity detail definitely makes the fund option sound appealing.
Doesn't it? It puts it in perspective. The source also prompted listeners thinking about gold to ask themselves why they're considering it. Is it just because the price has gone up recently, or is it part of a deliberate long-term strategy, maybe as a potential hedge against inflation?
And is it a good inflation hedge?
Well, that's debated. The source noted the historical evidence is mixed. Some argue it only really works as an inflation hedge over incredibly long time periods, like intergenerational wealth preservation. Though they conceded its recent performance during high inflation might make people question that traditional view, so it's not a straightforward answer.
Okay. Another interesting technical question came up about index funds. How do funds like the FTSE Global All Cap actually keep up to date? When do they change which companies they hold as businesses grow or shrink?
Yeah, that's a great practical question. The key clarification made in the source is that the fund provider, like Vanguard in this case, doesn't just decide on a whim, oh, let's add this company today.
Or just tracking something, right?
Exactly. Vanguard tracks the index. It's the index provider, the company that creates and maintains the index itself, like FTSE Russell for the FTSE indices or MSCI or S&P Dow Jones for others. They are the ones who set the rules and decide which companies are in or out of the index.
And how often do these index providers make changes?
It depends on the specific index, but for major global ones like the FTSE Global All Cap, it's typically done on a regular schedule, often twice a year, say in March and September. They have published rules based on things like market capitalization, how big the company is, and other eligibility criteria.
Some indexes have other rules too, not just size.
Yeah, some do. The S&P 500, for example, famously has criteria beyond just size, like needing to be profitable over a certain period. But the index provider manages all that according to their methodology.
So the index provider adjusts the index based on the rules, maybe twice a year, and then Vanguard, or whoever runs the tracker fund, just buys and sells shares to match the new index composition.
That's exactly it. They rebalance their fund's holdings to mirror the updated index. So over time, companies that shrink or fail to meet the criteria naturally drop out, and newly eligible or growing companies get added in.
Does this constant changing have a big impact on the fund's performance?
Usually not really is the reassurance from the source. For the vast majority of these routine changes, especially companies dropping out from the bottom of a huge index like the global all cap,
Were there only a tiny part of the fund anyway?
right, they might represent only, pennies of the fund's total value, as the source put it. So their removal doesn't really move the needle much on your overall return.
Unless something dramatic happens to a big company near the top.
Exactly. The exceptions are rare but significant events, like if a really large company that makes up a noticeable chunk of the index goes bust or commits massive fraud. They mention historical examples like Enron or more recently the German company Wirecard. That kind of sudden implosion of a major constituent can certainly have a noticeable negative impact. But routine changes, generally very minor impact.
Okay, that makes sense. Now let's talk about a situation that I suspect resonates with quite a few listeners. It came from a specific question too. Someone who's a bit older, maybe 10 years away from retirement. They've just received an inheritance, say £20,000. They've never really invested before, maybe never had spare cash, and are currently just expecting the state pension. It's easy to feel like it's too late, isn't it? Like you've missed the boat entirely.
Oh, absolutely. That feeling of, is it even worth starting now, must be incredibly strong. It can feel quite daunting. But the source offered some really positive encouragement here.
10 years isn't too late.
Definitely not. 10 years is actually a pretty decent time frame in investing terms. The speakers shared anecdotes about seeing huge positive changes in people's financial situations over just a few years, let alone a full decade. And starting with a lump sum like $20K is a fantastic base to build from. It's a great opportunity, not a reason to despair.
So for someone in that specific boat, older, first-time investor, 10 years to go, lump sum, what was the core advice from the source?
Well, it really circled back to some of the fundamental steps they recommend for almost everyone, perhaps just with a bit more urgency given the time frame. They referenced a webinar they recommended, highlighting key actions. First, build that cash buffer, that emergency fund. Absolutely essential, especially nearing retirement.
Get the safety net in place first.
Yes. Then really focus on maximizing any tax-advantaged accounts available. So pensions workplace or personal like SIPP and ISAs, individual savings accounts. Using these wrappers means your investments can grow free of income tax and capital gains tax, which can make a really big difference over 10 years.
Make the most of the tax breaks.
Exactly. And because they're only 10 years out, they absolutely need to start thinking about the exit strategy now. The deaccumulation phase, as it's sometimes called.
How they'll actually take money out in retirement.
Precisely. And that means starting to build that specific cash buffer, those 1 to 3 years of expenses we talked about earlier, specifically to protect against sequencing risk. You need that pot of cash ready so you're not forced to sell investments if the market happens to be down when you retire. Building that takes time, so you start now.
But, and this seemed important, they shouldn't just panic and stick the whole $20K in cash or be super cautious right away. They shouldn't assume it's too late to benefit from investment growth.
No, that was a critical point they emphasized. Staying invested, even in those final 10 years before retirement, is still really important. Why? Because the power of compounding investment growth building on itself is often strongest and most visible in those later years.
Like your 50s and 60s.
Often, yes. That's when your pot is typically biggest, so even average percentage growth translates into larger actual monetary gains. Slamming on the brakes too early, going overly defensive too soon, means potentially missing out on a very significant chunk of growth just before you need it.
So stay invested appropriately for the time frame while building the safety buffer alongside.
That's the balance. And they also suggested thinking flexibly about retirement itself.
How so?
Well, maybe retirement doesn't have to be a hard stop at age 65 or whatever. Could working an extra year, if feasible, make a big difference to the numbers? Could working part-time for a few years bridge a gap?
So viewing retirement planning as potentially more fluid.
Exactly. Reframe investing not just as saving up for one specific finish line date, but as an ongoing, often lifelong process of managing your money to support your life, whatever stage you're at.
Okay, great perspective. So as we start to wrap up this deep dive into all these listener questions, what are the absolute key takeaways we want our listener to really hold on to?
I think the first one is just accepting that market volatility, those ups and downs, they're completely normal. It's not a sign the system is broken, it's just how markets function. Don't let it derail your long-term plan.
And second, tailor your strategy to your own timeline. Decades away is different from 5 years away. You need to plan accordingly, especially building those buffers if retirement is closer.
Definitely. Third, prioritize your future self now. That pay yourself first principle for investing. Make it automatic. Make it non-negotiable.
Yeah, treat it like a bill. And fourth, keep it simple.
Yes. Investing doesn't need to be fiendishly complex. For many people, a single, low-cost global index fund can be an incredibly effective core holding. It provides amazing diversification very cheaply.
And really understand what diversification means. Just buying lots of funds doesn't guarantee it if they all hold the same stuff, like that U.S. tech example.
Exactly. Know what you own. And maybe the overarching point, drawing from that last listener question especially, and really the whole conversation, the hardest step is often just getting started.
Taking that first action.
That's it. It's okay not to have everything perfectly figured out on day one. Nobody does. Investing is a journey. You learn as you go. The risk of starting small, maybe with just a simple global tracker fund and making a few minor tweaks as you learn, that risk is pretty low.
Especially compared to the risk of doing nothing at all.
Precisely. The risk of never starting, of just leaving money sitting in cash, losing value to inflation over decades, that's arguably the biggest risk of all for your long-term future.
So maybe the real skill we should all be aiming for isn't trying to be a genius stock picker or perfectly timing the market, but just developing that consistent habit.
The habit of regularly putting money to work month after month, year after year, decade after decade, sticking with it through the inevitable rough patches as well as the good times.
Weathering the storms. So building on everything we've unpacked from these listener questions and the source material, here's a thought for you, our listener. Perhaps the real challenge isn't finding the perfect investment, but simply building that lifelong habit of consistent action. Well, it's one small step, however tiny, you could take today, right now, to either just get started on your investing journey or simply stay the course.